This is Professor Reynolds, and today we're going to be covering Chapter 8, which is budgeting. Now, if you're ever in a management situation or if you're ever an accountant, you most likely are going to be involved in the budgeting process. And if you are involved in a budgeting process and if you are a manager, then most likely you're going to be held responsible for that budget. And at the end of each month, you're going to be given a report, and that will compare the budget to the actuals. And again, you will be held responsible for that. So it's a good thing to know what goes into the budgeting process. Plus, obviously, it's going to help you in the course. So let me get rid of this. All right, so we're going to start out with the objectives of a budgeting. So it says here budgets play an important role for organizations of all sizes and forms. And this is a long, involved process. If you're a large company, it's probably going to be at least a 6 month process. I've worked as a vice president of finance for a major physician group, and that was a subsidiary of a hospital, and we started our budgeting process in um, January. But our fiscal year was ending June 30th. So really, it took us from January to June 30th to complete the budget. And it's not something where you do a budget and then that's it. It's lots of iterations depending upon the process. Objectives again is strategic planning, measurement, evaluation, and control. So strategic planning really involves setting goals to guide management decisions. You have the board of directors, and the board of directors really determines the long term strategic goals of the organization. And this would be things like, well, what products do we want to make? What geographical areas do we want to be in? What is our competitive position? Are we going to be like Walmart, or we are the low cost leader and also the largest company in the world? Or are we going to be a specialty um, company where we charge higher margins, but our sales in total are going to be less? You measure, and that's really part of accounting. Is that's what you're measuring is how do we do, and then you evaluate. Well, we thought we were going to do this well. How did we do? And then control. So once you measure, once you say, okay, this was our objective, and this is how we did, then you make plans to make adjustments so that you will then hit your budgets. And this could be anything from changing a certain part that you're using or changing the quality of a product, or it could be eliminating staff. A participated budget just means it's from the ground up. And so what you're doing is that everyone says, okay, you tell me how you're going to do. I've got to be honest with you. Not a lot of budgets are that way. Most budgets and most companies I've worked for, it really comes down to the CEO and the board of directors and said, hey, how much do we want to grow? So, human behavior. We all like to hit our goals. We all like to get a bonus. So, during the budgeting process, some managers will try to uh, like the budget so that they basically know that they're going to hit their numbers. And that's just human nature. No one likes to not hit their numbers. No one likes to go to that conversation and have to explain why you didn't hit your numbers. So sometimes that's called sandbagging, sometimes it's called budgetary slack. So really what you're trying to achieve is budgets that are achievable, but that do require you to stretch. I mean, you've got to stretch, you've got to continually improve. So it should be easy. If it's easy, then you're not really utilizing all of your resources and you're not doing what you really should do. So there are budgeting games, and some people know that certain departments will always seem to hit their budgets because they have budgetary slack. You have different budgeting systems, and sometimes it might be as simple as an Excel file. Although Excel is a great program, unfortunately, if you make a mistake and if you have a formula that's a little off, it can just skew everything. And so, really, you needed budgeting systems that are tied with your accounting system so that they're automatically uploaded. And you automatically, all you have to do is pull a report and then it'll compare budget to actual. There is a continuous budgeting. Most budgets are done on a 12-month basis. The problem is if you have a budget and you have a fiscal year from January to December, you're starting the prior July. And so you're really looking at that point 12 or 6 to 18 months out. Is that really possible? I guess it really depends on the business you're in. But remember, we had COVID. If you were in the food service industry, you came up with a budget, and all of a sudden, COVID hits and your budget's out the window. A continuous budget just basically means you're always budgeting the next 12 months. So at the beginning of January, you're budgeting January through December. At the end of January, beginning of February, now you're going to budget from February to January. At the beginning of March, you're going to budget from March to February. Or I think I might have said that wrong. February to January. Yes. Now that has a lot more practicality in that you're only really always looking 12 months out, but it does mean that you're always budgeting. Whereas zero based budgeting just means you start from scratch. I don't know a lot of companies that do that. Incremental budget just really says, well, what did we do this year? And that really is what most companies do, and that makes some sense, unless you're really making significant changes to your operations. Most companies use static budget. In other words, we are looking for a number. We want to make $1 million this year. And so if we make $1 million, if we exceed that, then we all get bonuses, and that's great. That's called a static budget. And so you're looking just for that number. The problem here is that the disadvantage of static budgets is they don't adjust for changes in activity levels. Now, there's a saying that a rising tide lifts all boats. And what that means is if you exceed revenue, most likely you're going to exceed your earnings budget. But it doesn't tell you whether you did that effectively and efficiently. So you could be wasting an opportunity here. And what that really means is that, yeah, you exceeded your target, but your margins suffered. And so that's not a good thing. So a static budget doesn't really take that into account. A flexible budget, though, does. It will say, okay, if we do 8,000 units, we should make this much. If we do 9,000 units, we should make this much. If we do 10,000 units, we should make this one. So what this does is it provides us a better understanding of where we really should be. So if our revenue goes up, our income should go up more than maybe it does. So that allows us to evaluate whether we're using our resources effectively. So here is an example where, hey, we actual results were 70,800. That exceeded our static budget, so that's great. However, we should have made 71,000. So we wasted an opportunity here. Developing budgets, companies use a variety of approaches. Again, spreadsheets, like Excel. Excel again is a great program, but if you have one formula that's off, it can really mess things up. Whereas an integrated budgeting planning is tied to your results and it's automatic. All right, so we have the master budget, which is just an integrated set of operating financial budgets. And there's a lot here, but what I'm going to basically emphasize is that everything is related to the sales budget. So if we think we're going to produce 10,000 units, then number one, we have to have the manufacturing capability of producing 10,000 units. If we only have the manufacturing capability of producing 5,000 units, then we're going to need to expand our capacity. And then you have the cost of goods sold budget and the production budget, and that's going to depend on the sales budget. If we're going to sell 10,000 units, first, well, how many units do we have to begin with? And how many units do we want to have at the end of this period so that we can be ready for the following year? And so that's going to determine your production budgets. So everything is related to your sales budget. If you say, well, we want to do 12,000 units, then again, you're going to take, well, what have we started with? What are we going to sell? What are we going to end up with? And all that is going to be related. Your materials budget is going to be related to your sales budget because that's going to be related to your production budget. Same thing with direct cost, factory overhead, selling and administrative budgets. So if you're going to sell 10,000 units, you need the sales force to be able to do that. You need to promote your product so that you will sell that many units. You need people able to fulfill these orders for 10,000 units. So all of that is predicated on the sales budget. And then you have the cash budget. As we know in GAAP accounting, because of accruals, cash and GAAP accounting are not the same. So we need to look at the cash budget. Capital expenditures budget is going to fall into this cash budget. So, for instance, let's say Chick-fil-A, they've expanded a lot of their stores to where they have two drive-through windows. All right. And so they needed to get cash so that they can uh, have the resources to expand, to uh, put all of the infrastructure there, to staff it accordingly. And those are costs that are going to be expensed over time. And so that's going to be the capital expenditures budget. That's going to affect the cash budget. So you have the operating budgets, which is really just like your net income. You have the cash budget, which is going to be some like your cash flow statement. And you have your capital expenditures budget. Sort of depicts that. So again, your operating budgets are going to be all predicated on your sales budget. So if you want to make a lot of money but have a lot of risk, then you're going to be the sales manager and you're going to help forecast what the sales are. And if you're on, then you'll probably get a pretty good bonus. If you're off, you probably may get fired. All right. So then a lot of this is going to be predicated. Okay, so we think in the East, we're going to sell 280,000 units, the West, 241,000 units for wallets and handbags. And what is our sales price? Is going to be 12 bucks a piece, handbags 25 bucks a piece. And so this is going to be our total budgets for our revenue. And then again, based on that, we've got to come up with that many. So the budgeted units is going to be, well, how many do we think we're going to sell? How many do we need in ending inventory? How many did we start with? And so that is going to be the number of units we want to produce. And so you can see here are the desired ending inventory levels. Here is the estimated inventory at the beginning. And so this is going to be the number of units that we're going to be produced. So we're going to sell 528,000 units for wallets. We are going to end with 80,000 units here. We believe we have 88,000. Hopefully, it's more than just a belief. And then that means we're going to need to produce 520,000 wallets and 292,000 handbags. And so then again, all right, well, how much leather do we need that many wallets for that many handbags? How much lining do we need? Et cetera, et cetera. So everything pretty much flows from that. And it's very similar, just like, well, how many handbags do we want to sell? How many do we want to have an ending inventory? How many do we start with? Same thing. Okay, so how much material do we expect to use? How much material do we need to have at the end of the year to go into the next year? And how much material do we start with? So all of that is very similar. And so you can see here, it'll show you how many square yards, desired inventory at the end. So that's the total available. And here's what we're starting with. So this is the total square yards we're going to be using times the unit price, et cetera, et cetera. And so then it just kind of flows down from there. Same thing with the direct labor. Again, all this is predicated on the sales budget, factory overhead, etc. We're going to estimate this based on, well, we need to produce X amount of wallets and X amount of purses. So what do we need to be able to do that? Well, factory overhead, factory wages, indirect wages, everyone associated with that. So the production manager is going to estimate this based again on the sales budget, based on the production budget, etc. And so they're going to come up with that. And then they'll figure out some way to spread overhead. You've all looked at those. So you should be familiar with those different processes. And cost of goods sold budget is going to be very similar. Again, selling and administrative budget. Well, if we're going to sell this many wallets, what do we need? How many stores do we need? Are we going to sell to a third-party company like Walmart, etc.? We still need people to contact Walmart, to work with Walmart. We still need people to process these orders, to move them out of the factory and move them to Walmart. We need people to record all the transactions. We need HR people, etc. But again, this is how many HR people do we need based on what we're going to produce. And then from that, we come up with a budgeted income statement. And so we expect to make, and this is again a static, we expect to make $1.8 million. And then you have the cash budget, of course, and the capital expenditures budget. Cash budgets estimate the expected receipts. So we're going to time the receipts. Well, when are our sales going to be? All right. So, and when are we going to get paid? Because when you sell to a customer in this situation, you're probably not going to get paid immediately. It's going to be, you're going to extend credit and they may pay in 30 days, 45, 60, etc. You have to have cash to pay people. So you will then estimate based on all of those factors and how much you're going to need to pay for all the leather that you're going to need and pay all the salaries that you're going to need and pay all the overhead. So you're going to come up with a monthly cash budget and then determine whether you need to borrow money, short term, etc. And then you're going to again go through and say, well, if this is the production budget, when do we need to pay our vendors and when do we need to pay our employees, etc. So you complete the cash budget. Same thing with capital expenditures budget. If you're a cab company, okay, how many cabs do I need to replace? Well, I've got to come up with these and I've got to pay for these somehow, either by loans from banks or by issuing debt. But somehow I have to acquire these cabs. And then I have other cabs that are going to be retired. So, do I get any money for these cabs? Are they worth anything? And so all of the fixed assets and intangibles that you need to purchase are going to be part of the capital expenditures. And so from all of this, you're going to come up with a balance sheet, and that'll tell you how much cash you expect to have, how much debt you expect to have, what you're going to owe your vendors, what people are going to owe you, etc. So this is again a very involved process. Let's see what's important in this. Again, sales budget. Quarterly sales budget is prepared using those estimates. Then again, production budget, direct materials budget. Let's see what else is left here. So we pretty much covered all of this. All right, so I'm not going to go through any of this since this is the appendix, but again, in summary, the sales budget is what drives all the other budgets. You have to have the production capabilities. If you decide to expand your capabilities, that's going to affect your capital expenditures budget, and it's also going to affect your ability for your sales. But you've got to be able to produce the number of units you expect. The number of units in production, again, are dependent upon the sales, and you start with, well, here are the sales I want to make. Here is the ending inventory. Here's what I begin with. So that's the number. And that flows down to everything else. That will flow down to the cost of goods sold budget, to the materials budgets, to the direct labor budgets, to the overhead budgets, etc. So I hope this has been helpful. I would go through the chapter again, but this should give you a good overview of chapter 8.